Joined now with Michael Guckes. He is Chief Economist at ConstructConnect. Good morning, Michael.
Good morning, Trinity. Thank you for having me.
It's great to have you. Now, what do you think if the Fed makes multiple rate cuts in 2025? How quickly might home buyers see relief in mortgage rates? And how closely do mortgage rates tend to follow Fed rate changes?
Yeah. So, we've been looking at that here at ConstructConnect for the last several quarters here, and really since September, when we think about what the Fed did with the start of lowering rates, we've seen some interesting things happen with the 30-year mortgage, as Harvey Flack mentioned just previously. When we look at that, we don't see the high correlation maybe that we would expect, right? We've actually seen the 30-year mortgage rate hovering around 6.5%, even though Fed rates continue to come down. So the question becomes one of, as the federal funds rate continues to slide lower moving into 2025, really how much of an impact will that have? It has yet to be seen. And I think for builders, we do need to be concerned with the idea that, 30-year mortgages aren't going to drop as quickly as maybe we anticipate. And if that's the case, then there are going to be a lot of existing homeowners that are still going to be locked into their existing homes because those rates are just so attractive, and you don't want to give those up.
Yeah, and Michael, how is the divergence between new home sales and limited supply of existing homes impacting the overall housing market, do you think?
Yeah, so fantastic question. What we're seeing there is that we have a historically low number of existing homes for sale on the market, right around 4.2 months of supply right now. In contrast, among new homes out in the market waiting to be sold, there's a 9.5-month inventory there. And so we see this divergence going on among existing home sales and new home sales. We have this glut effectively of new homes for sale waiting to be sold. And the price difference between existing homes and new homes has narrowed so much that if we do see falling rates, right, that would be good for all home sales. It makes them more affordable, which we know right now they're historically unaffordable. But at the same time, if that brings a glut of existing homes onto the market, right, that creates a substitute goods problem. And all of a sudden, home buyers are going to have a lot more options among existing homes to purchase, and that might hurt some of that new home sales optimism.
Let's talk more about interest rates. If falling interest rates incentivize existing homeowners to sell, could this create an oversupply of challenges for home builders?
Well, it could do a little bit. One of the things we have to look at is not just the number of starts, right? But we look at the permits, right? The permits data, as you pointed out, is pretty good. Relatively speaking, 1.5 million units, seasonally adjusted. The question becomes one of, again, if those falling rates, while at the same time inflation holds right around where it is, and importantly, job growth and job wages remain in real positive growth terms, right, that will make housing more affordable, right? We're seeing wage growth around 5.75% right now in nominal terms. You back out the 2.7% inflation that we're seeing right now. So you're seeing some real wage growth, and that will certainly help with the housing affordability. I think with the concerns that new builders are having around, how do we make new homes more affordable?
And from where you sit, Michael, how is a strong job market with low unemployment and steady wage growth affecting the housing market's ability to balance affordability and demand?
Yeah, so it's struggling right now. As we know, both the National Association of Realtors and the National Association of Home Builders have pointed out that affordability is a real challenge. It's at historic lows. As real wages do grow, and I think as we said, mortgage rates begin to tick down at an uncertain pace, it will make them more affordable. It will unlock some of that. The other thing of real interest is that strong jobs picture, I think, has really helped keep home delinquencies low, right? Home delinquencies right now are running below 1%, and so that's very good. It was even lower earlier. In 2022, for example, it was quite a bit lower, but still, at around 70 basis points, that's a really good home delinquency rate. Hopefully we can maintain that through a strong jobs picture.
Given the current trends that we're seeing right now in the overall housing market, we have a new administration taking place in January. What's your outlook for the U.S. housing market in the next near term, especially the first quarter of next year?
Yeah, so one of the things I'm excited about is maybe changes to financial regulations. Having lived in that space for several years, we could see that changes there allow banks to free up more capital. That could help with some of the mortgage rates. It could certainly help with the loan officer survey data we see, which basically says how stringent are banks going to make 30-year mortgage loan offers, right? If we see the terms ease in that area, right, we could see more banks making more mortgages and loans available, and that could certainly help the market with, the ability of new home sales.
Well, thank you so much for joining us on the show. As always, you offer some great insight, Michael. Michael Guckes, Chief Economist at ConstructConnect.
Thank you.